Welcome back to segment 2 of this show. We're talking to Brad Feld. Now we're going to talk a little bit about, is there a pattern? Is there a certain DNA or formula or recipe for success? I personally, assuming anybody cares, I always say it's vision, ambition, execution, determination, luck, and timing. That's studying a lot of successful people. First of all, do you agree with those 6 ingredients? Am I missing one, or some of them don't belong there?
I can't remember 6 things in a row, so there's too many of them.
Okay. So let's simplify.
They all sounded good, but
sound very good. Yeah, that's the problem.
Nice
they just
words.
sound good. Yeah,
They're nice words.
Yeah, exactly.
They all have multiple syllables.
Okay, well that's actually the point. Let's start off before assuming that there are 2 or 3. Is there a formula for successful entrepreneurs and successful companies in your portfolio?
So in my universe, yes, I don't have any idea whether it's statistically relevant for the whole universe, so I won't think about it that way. But from the standpoint of the things that we've been involved in, there are a couple of very clear traits that are common. The first is that we're investing in entrepreneurs who are incredibly obsessed with a product. So the way we make decisions about what we want to invest in is we focus on a set of themes, and if you're not within a theme, which you can find at foundrygroup.com/themes, if you're not within a theme, we pass immediately. If you're within a theme, these are areas we know extremely well. They're areas that we view have 20 plus years of investing opportunity in them.
How many themes are there?
About a half a dozen. But
what are they?
They evolve all the time. Human-computer interaction would be a theme. The premise that the way we interact with computers over the next 20 years will change radically. Protocol, companies that are built around both real technology protocols, IETF protocols, as well as ad hoc protocols. So email, SMTP, push notifications, right? They don't have to be a standardized protocol, but a thing that becomes accepted as a protocol. Glue, which in the 1980s would have been called middleware, and that is essentially the stuff that glues together machine-to-machine interaction. We have another theme called adhesive, which is glue in the ad tech universe. So we don't like to invest in ad networks, and we're not ad tech investors, but we invest in this glue layer. So those are a couple of the examples. For us, once something's in one of those categories, one of those themes, we go very, very deep on the people and the product. And our focal point is we want entrepreneurs who we want to be partners with for a long time, and they want to be partners with us for a long time. So it's both directions. They have to choose us as much as we choose them. And then we're looking for entrepreneurs who are incredibly obsessed about a product. And in most cases, it's a product that we have an affinity for. It doesn't have to absolutely be a product that we have an affinity for, but they have to have a deep affinity for it. The best of those entrepreneurs, over time, make their company the product. So they start with this incredible obsession on a product, and over time, scale it up as the business gets bigger, where the company becomes it. Those are the 2 things we're looking for. And it's had incredible correlation. People who were working on something just because they wanted to be an entrepreneur or thought the idea was good but weren't obsessed about it. There were a lot of different personality traits. I think trying to segment by personality traits has not been terribly successful. We invest in lots of introverts, a lot of extroverts, people who are intrinsically motivated, extrinsically motivated, a whole range of experience along the curve, technical founders, non-technical founders. All have been successful, and by the way, all have been unsuccessful, right? So those don't seem to be the balance points for us.
You touched on a lot of good stuff. One of them was this notion that you want your entrepreneurs to be partners with you for a long time. What are your thoughts on the whole sort of pivoting, failing fast, recent, mantra?
So I think that there's some amazingly important things about the notion of failing fast and pivoting that are grotesquely misinterpreted. So the thing that's important to recognize is that any business is a series of things that work and things that don't work. And the great entrepreneurial curves and the great startups are the ones that when you realize something's not working, you pivot or you kill it, and you double down on the stuff that's working. And you continue to do that through the life of the company. So companies aren't these straight lines of success of different vertical slopes, of these sort of crazy oscillating things where your hope is that over time you have the success. The misinterpretation is this notion that you should give up, that you should throw it away. There are cases where you should call it quits. So, I've had the conversation with a number of entrepreneurs who went on to have an amazing next experience when they held on to this thing that just wasn't working. And you say, look, just let it go. This one didn't work. And the entrepreneurs who go through a success curve and a failure curve are the ones that are the most fun to work with because they know what they both taste like. And so they're able to sort of understand that in their brain versus the ones who have, I've only ever been successful, and you're in this denial about what's actually really going on. Or then the other side of it, which is the ones who have not tasted success. That's okay too. It's just harder because then you're sort of in this cycle, especially if you had 2 or 3 things that haven't worked, where you're struggling to see what that success curve really is.
How much of your job is that, like almost being a cheerleader / psychologist with the entrepreneur? Or is that something that you or other investors sort of shy away from because you don't want to be...
Yeah, I actually don't know about other investors, nor do I really care. So I think I sort of view it from the standpoint of what my 3 partners
Brad's universe.
what my 3 partners and I are, I say Brad's universe, Founders universe, I mean what we're good at and what what are our values. I think an enormous amount of what we do is be intellectual and emotional support for the entrepreneurs and for the CEOs of the companies, who oftentimes are the same as the entrepreneurs. That it's both intellectual and emotional. Like we can provide lots of knowledge and experience, and lots of from my experience I did this, or I think you should think about it this way. But an awful lot of that is just emotional too, right? Being a CEO of a company is really lonely. And it's especially lonely when things aren't going the way you want them to go, or when you haven't had the experience. Rand Fishkin from SEO Moz, wrote a great blog I saw today on his blog about essentially slowing down to speed up, and sort of the dislocation that happens after you raise a big financing, after you've had a company that hasn't had a lot of money. And you see this, I've seen this over and over again. You have a period of 6 months where it feels like you're stuck in molasses. And you're not, you're just doing things that aren't externally visible, and you're building a foundation to be able to really accelerate the business. And sometimes that doesn't work, but most of the time it does. But the entrepreneur who's used to this continual improvement on a shoestring all of a sudden thinks, well, I have all this money, everything should be awesome. And in fact, you go through this sort of cycle where you question, do we suck now? We don't know how to get these things out. We're slow. Your customers start saying, hey, you used to release something once a week and it's been 2 months. What's going on? And figuring out all that stuff. I mean, we've seen it over and over again. So I don't have to say, it's okay, don't worry, let me give you a hug. I mean, I can do that. But you can also provide real substance around, well, this is what you're going through, and this is how I would encourage you to think about it, and here's some people to talk to. And that's very emotional versus just purely intellectual.
Yeah, the analogy I use is if you're wandering in the desert with no water and all of a sudden they throw you in the pool, that's going to mess up your...
You're totally screwed.
I went through that in like 2010, 2011. I was like, wow, okay. So I had a question that was, what's the biggest mistake investors make? But I won't ask you that. I'm going to ask you, what's the biggest mistake you make or you've made, and what you've learned?
I would say there's 2 mistakes when I look back at history that I've made. One mistake, which I believe I don't make very often anymore, is not confronting reality as quickly as it appears. So there are lots of cases where you see a path and you can predict that the path is going to go somewhere, and you don't confront the reality of it. Now, there are cases where you decide to let the path play out because the entrepreneur needs to learn it for himself. But there's a way to do that while still confronting it. And an example would be the company that has a fantasy expectation of what they're going to sell, and they build their cost structure associated with that fantasy expectation of what they're going to sell. It doesn't mean that the entrepreneurs are bad or the company's bad. You know that's going to be out of calibration. And I used to not be as tuned into the best way to deliver that advice, and in some cases sort of hope. Well, I hope it'll be okay. Versus saying, I think this is what's going to happen. It's your call whether you want to execute this way or not. But here's the cutoff points that I'd encourage you to put in place. I've gotten a lot better at that. Problem number 2 is, when I started making investments, in the first 40 angel investments I made, it was all about people and product. That was it. As an investor, I was just totally focused on people and product. I want to be your partner, and I think what you're doing is awesome, and I think you think what you're doing is awesome, let's go. I then went through a period of time when I was at Mobius Venture Capital, so 1997 to about 2003-ish, where there were a whole bunch of other things that crept into the analysis. Is the market size big enough? Is the management team strong enough? What's the competitive dynamics? And when I look at how we invest today, we're totally focused on people and product again. And the biggest mistake that I made as an investor was losing that focal point, losing the notion that, if I knew, why does it matter what the total available market is? Just pick a big market. And if you can't define what you're doing as a big market, why are you doing it? And you certainly won't be obsessed about something if the opportunity space isn't big, right? So there's some things that you can do to solve for that. Is the management team in the company when we invest in it going to be right? Of course not. But part of what we can do is help make the management team awesome.
Okay, so I don't want to segue into Zynga to assume or project that Zynga was a mistake. Zynga, I think, was an unbelievable company when most investors put in their money, but clearly after the IPO, something is off the rails. Like either the train's getting off the station, off the rails, or some things are happening that they did not expect. So you could talk as much or as little about Zynga in particular, but Zynga and I would say almost all of the social IPOs apart from LinkedIn make me wonder if the criticism that VCs are more concerned with just flipping a company and saying now it's some other sucker investor's problem is valid. Do you think that investors are interested in building companies that scale and last? Or is it just companies that scale fast and then they could sort of get liquidity?
Well, I think a venture capital investor and firms from firm to firm will have different strategies and sort of different views on what they do. At Foundry, we view ourselves as early stage investors. We're not apologetic about it. We view that what we're doing is helping create a company. Our belief is that the great entrepreneurs are ones who are trying to create a company that is enduring for a very long period of time. And we view our role as helping and supporting the growth and development of that company up to one of 2 points. The point at which somebody acquires the company, well, 1 of 3 points, I guess the point at which the company fails, a point at which somebody acquires the company, or the point at which a company goes public. A point at which a company goes public is just another step along the company's way. But for the company, for the way we invest in the time frame that we invest, the IPO is a transition point for us from one stage of a business life to another. And that transition point doesn't happen on the day of pricing. That transition point happens the day that the company decides to file. I was on a bunch of public company boards in 2000, 2001 timeframe, and I realized a lot of things. One is, it wasn't a very satisfying experience to me. I didn't enjoy the work. The second is, I had strong emotional support for the entrepreneur and for the business that was being created. It didn't naturally map to how I wanted to spend my time. And the constraints of being on the board of a public company change all of those dynamics. So I think our view as an investor is we're happy to support the company with the idea of a very long-term build. An example that I would give you of that would be a company like Return Path, which we've been involved in for 12 years. We plenty of chances to sell the company, but entrepreneur Matt Blumberg, who's a CEO, is awesome CEO, is building a really significant company. He wants to run that company for a long time. That's great. He wants to take the company public and continue to run it. That's great. It is not logical from my frame of reference in terms of our goal to carry on. I would also add that I have absolutely no understanding of public market investing. I have no desire to understand it. It's not something I do. I don't own any public company stocks other than the stocks that I own from companies that I've been involved in that have gone public, or companies that I have money with asset managers who have public company stocks. I don't even know what they are. So my view is I don't have any way to analyze the relative value in the public markets. And my view that the current values are right or wrong. I don't know. What I do know about companies like Zynga is I look at that company. I remember it was 10 people when we invested, and it's 3,000 people today. It was $100,000 a month or even less when we invested, and it's $1 billion plus a year today. That's a pretty extraordinary cycle. And to understand what's going to look like in 20 years, I don't know. And you can go back in time and calibrate based in time, right? There's a moment in time where Amazon was worth almost nothing, and everybody said Amazon's going to go out of business. There was a time, people forget, that Oracle was almost out of business. And Oracle is one of the most valuable companies. There was a time when Apple was worth very little more than it had cash. And so the dynamics of how the public market views things, it's just a relatively short cycle on a long-term arc.
Okay, good stuff. We're going to take a short break, come back. In the final segment, we're going to do lightning round. We'll be right back.